Today I am talking about the kinds of option trades that we like. First, we're looking at GY, GenCorp, and we're looking for the studies. We have the price here. I omitted the volume. We have the price here, and we have our volatility graph down here. Just to simplify things, I'm only going to insert option volatility. So this is the option volatility, the implied volatility. All right. Now, first we do our traditional technical analysis. Say, okay, here's the 1-year chart. What can I see? I see a downtrend, downward channel, and then an upward breakout. In the weekly chart, that might actually look like a bull flag. But anyway, this right here is bullish. Now, we could buy into that. We could say, okay, I'll buy a call or something. But you don't want to be so naive. You want to check volatility first. You want to see what the option prices are. And you can use this with the implied volatility graphs. And I'm sorry that it's so choppy. Unfortunately, people's perceptions of how volatile stock are extremely choppy. So we have to play their game. Now let's take a look. Just to give you a brief overview, and I'll write this down, the higher, and I'm using IV, that's implied volatility. The higher IV is, the more expensive options are. And I wrote that right there. Get that size a little bigger so we can actually see it more. There we go. Higher IV, the more expensive options are. So we could say right here at this big peak here on like January 31st, options were very, very expensive. Why? We can always look at the graph and see why. February 31st, it was the day before earnings. Tends to happen. People want to buy options the day before earnings because they like the whole idea of being protected against risk if they're wrong, or just people's expectations. So expectations will drive prices up. Now, conversely, the lower implied volatility is, the cheaper options are. Let's again change that font to something that's readable. So we can take a look, and I'll put that right there even though it's still kind of high up. We can take a look and say, all right, so times that options would be cheap would be, for instance, right there at those two little bottoms. Right here, options were very cheap. And actually, yesterday, Friday, and this might carry on till Friday, who knows? I mean, this might carry on till Monday if you want to make a position in the stock, who knows? Right here, dirt cheap. Actually, you go to the 2-year chart. There is only one other time that options have been below. I mean, the option volatility has been below where it is right now, and that was in July of 2009, 2 years ago. Now, so we can basically say, what we have right here, we have a very good situation. We want to buy an option right here. And as you saw in the post, I said, it's times like this that it seems like traders are going to sleep. And right when traders go to sleep, something big usually happens. So we'll take a look at here. We'll take a look at this time period. This was the summer of 2009. And we're going back to that July 27th date. The lowest option volatility of any time. What was happening in the stock? Pretty much nothing. But on July 28th, once all the traders fell asleep, we would buy an option in this area, and then shortly after, the price of GY over the next 6 months, actually over the next 4 months, I think, just to make sure I'm doing my math, 4 months, it went from under $3 all the way up to $9. So you see what I'm saying? When everyone falls asleep, that's usually right when a big move is about to start. Actually, we can go to the other ones. Take a look at, what's another bottom? We'll go to this bottom, just this April. Options implied volatility was very, very low on this date. Options were cheap. What happened over the next few months? Downtrend. And now, of course, that's reversing. Now, the problem with options volatility, because options are cheap, it doesn't mean that it's going to be bullish or bearish. All it can tell us is that something's about to happen. And actually, you can even, once again, go to that 2-year chart. Every single time that, and I'm going back to this big graph here, every single time that options volatility has dropped below, has dropped below the 40 level, and that's just 4, you can see in that right hand scale, every time it's dropped below that 40 level, which I only have 2 or 3 times that this has happened, a big move ensued. So something's always about to happen. So what would I do in this situation? I'd say, okay, options are dirt cheap. Like, for instance, right now, I go to GY, I go to the February 2012s, I can buy nearly 8 months. It's 230 days from now. I can buy an option that expires then for like 40 cents. And I can also buy a put for 25 cents. So what did I do yesterday? In these times, since option volatility does not tell you what direction the stock's going to go in, you would buy what's called a straddle, which is you buy both a put and a call, 100% debit spread. So buy a put and a call, and you want to find the best priced one that you can. And by best price, you just look at the implied volatility. So for the calls, hopefully you can see this. I'm looking right in this line. You look at the percentage, 35.81. You want the lowest one. You buy that. You look at the percentage. You have 40.91. Well, I guess I did make a mistake yesterday. I should have bought the next one, the 7.5, but I was not willing to put up that much premium for risk. But what you don't want to do, you don't want to buy the ones that are very expensive, like this one, 96.15. You don't want that. Or like even out here, look, 88, 173, 230. You don't want that. You want something very low, because that means that you're getting a bargain. So yesterday, I bought a put, I bought a call. It's called a straddle. Now, if I go back to this chart, you do some mean reversion. Generally, we can say, and this is just eyeballing it for me, generally we can say that volatility tends to find a happy medium around the 100% level. So, we'll go to our pricing calculator just to see what would happen. Alright, right now this is saying that the theoretical price of the 2 options I bought yesterday was 38 cents and 23 cents. Volatility right now is around, for the both of them, on average is about 30%. What happens if it gets back to 100%, where the stock normally tends to be around? And I'm not saying that the stock is going to move at all. If the stock stays the same and volatility goes up to its historical average, the price that, let's see, how much of a profit would I make? On the call, I would make about a 500% profit. On the put, I would make a 600% profit. That's pretty nice, right? For the stock not moving at all, just people's perceptions. Yeah, so it's times like this that you really want to start buying stuff. And for the risk right now, I'm risking $65 and I have an infinite possible gain. Like I said, it's a good time to buy options when you see these situations. Alright, Cliffs. Historical lows in option implied volatility usually means that people are falling asleep, usually means that a big move's about to happen. At these times, they don't really tell you what direction the stock is going to go in, so unless you have some kind of technical backing, like a breakout from a pattern, generally you could buy a put and a call. You want to buy the options with the lowest implied volatility because that means that they are quote-unquote the cheapest, and you want to wait to see how volatility plays out. Don't take a lot of risk on these because you can be wrong. Set a money management stop at half your initial investment. Alright, thanks for watching. If you have any questions, post in the comment box.